Now, let's speak about distinctions between limited liability company and company limited by shares. When we speak about limited liability company, the same situation as in company limited by shares is minimum number of participants or shareholders. But in case of limited liability company, we have maximum number of shareholders. In case of company limited by shares, we do not have limited number of shareholders. So it can be 10 million shareholders, even if it is not a public company limited by shares. Next, withdrawal. So I invested my money and I want to withdraw from the company and I will take the share from the company. It is possible in limited liability company if it is provided by the charter. In company limited by shares, yes, redemption is provided but as an exclusion. So only in the very rare cases it is possible to withdraw from company limited by shares without having a buyer for your shares. Next, when we speak about dismissal, in limited liability company, so let's suppose I have 10% of shares, and I can claim in court dismissal of another participant. Why? Because, as you remember, in cases of, for example, liquidation or reorganization, 100% of shares is required from shareholders to vote for these matters. And if somebody has just 1% of shares and does not appear at the general shareholders meeting, we cannot take this decision. So that is why in limited liability company it is possible to dismiss a participant. In company limited by shares, you cannot dismiss a shareholder unless you are a supermajority shareholder of 95% of voting shares. In this case, first you have to apply that other shareholders sell their shares to you, and then if they do not, you can buy out these shares from these shareholders on market price. In other situations, there must be their consent. In company limited by shares, board of directors is a must. Board of directors of minimum 5 directors. In limited liability company, it is optional. Reserve fund is not required in limited liability company and is compulsory in company limited by shares, and it must be at least 5% from charter capital of the company. And additional contributions to assets are possible in case of limited liability companies, so disproportional contributions without consent of other participants, which is not possible in company limited by shares. If we compare companies limited by shares, the public one and non-public one, we can see that there are slight differences. The amount of charter capital in public company, it is 10 times higher. And when we speak about non-public company, it is a limited company. So that means it is a closed entity. And that is why normally there is priority right of other participants to sell shares. What it means? So, for example, we are 3 shareholders here, A, B, C. And C wants to sell his shares to D. So C first shall offer his shares to A and B, and if A and B do not buy, or they immediately say that, okay, no problem, then you sell to D. If A or B say that we would like to buy, then C must sell proportionately to the shares of A and B, shares of C in this staged capital. In public company, no problems. So here there shall not be limitations. But what is the same in public and non-public? Every year audit, compulsory audit, public information, so annual report, accounting balance, profits and losses statement, these are public documents. When we speak about public subscription, so we say public company, that means public subscription. Of course, if you want your shares to be quoted at the stock exchange, it is only public company. But, for example, in non-public company limited by shares, you can have 1 million of shareholders, but you do not quote shares. So how do you raise your funds? For example, by crowdfunding. In this case, you can be non-public company because you are not quoted at the stock exchange. So that is why public subscription is a question. So if you want your shares to be quoted at the exchange, then of course we speak about only public company. That is it. Next, what is important here? We shall speak about types of shares in company limited by shares. First of all, look here. When we speak about Russian Federation, we speak about only non-documentary share. So there is no paper which is called a share. That is why a share is something which is in electronic form. You cannot find a share somewhere. But if you need a proof, it is easy. You go to registrar and your registrar provides you an extract that you're a shareholder of this particular company with this particular shareholding. Next, in the Russian Federation, we have only registered shares. We do not have bureau shares. So we have shares in name. It is not possible to have some nominal holding share. It is in name. Next, placed and authorized shares, both possible. So placed shares, shares which are paid. This is our charter capital. And authorized shares, potentially. So for example, we issued 100 shares. But potentially, so authorized shares, what we can issue is 1 million shares. And next distinction, ordinary and preference shares. Ordinary shares means voting shares. They vote, they accrue dividend, they result on business activity of the company. So if business activity goes down, it is possible that no dividend is paid. If it goes up, so very high dividend may be paid, depending on results of the company. Depending on your portion in these ordinary shares are your rights in the company. So for example, if you have 1 share, yes, you can claim what belongs particularly to you. But if you have 1% of shares, and 1% of shares in some companies, it is quite a lot. So for example, 1% of Sberbank is Vekselberg, so it is quite a lot sometimes. So in case of 1% of shares, you can claim to know other shareholders. And if you have 2% of shares, you have a right to nominate persons to board of directors. And if you have 10% of shares, you can claim extraordinary general meeting. So everything depends on volume of shares you have. And when we speak about preference shares, so preference shares, preference to what? Normally it is preference to dividend. So we stipulate particular dividend, and this dividend shall be paid on preference shares. Also, preference shares may be preference to liquidation value. And normally preference shares do not vote. So when we speak about voting shares, we speak about always ordinary shares, but preference shares generally do not vote, but sometimes they do. So, for example, preference shares do not vote when you did not pay dividends. So, today you decided not to pay dividends on preference shares, so you withdrew from preference shareholders this right to dividend. You must give something back. So you give back this possibility to vote for preference shareholders. Or in particular questions like reorganization or liquidation, or amendments limiting particular rights of these preference shareholders. Also, there may be convertible preference shares. And finally, let's speak about other types of shares. So convertible, we already said, so preference shares shall be converted into ordinary shares. Preference shares or ordinary shares may not be converted into bonds, but it is possible that companies issue bonds which are convertible into preference or ordinary shares. So the general rule is less risky securities are converted into more risky securities. When we speak about golden share, we speak about the share of the state in the company. And what is golden here? We speak about veto rights, we speak about presence in board of directors, we speak about presence if we speak about bankruptcy, for example. And cumulative shares. Cumulative shares means shares which do not lose dividend. That means dividend, even if it is not paid, it is accrued each year. And if you have not paid dividend for years 2017, 2018, 2019, but then you decided to make silent cumulative preference shares, you must pay all these dividends. If you still own 1 ruble, these shares still will be voting. So dividend is accrued on these preference shares.